My name is David Charron. I'm the Executive Director of the Leicester Center for Entrepreneurship and Innovation at the Haas School of Business. And very big congratulations to the Haas School of Business. The Economist has just recently rated us the #1 business school in the United States. So, good. We, of course, are delighted by that rating. Not that we seek them out, but we're delighted when we get them. So let me do a couple of words of introduction. So we live in the place that is known as Silicon Valley. So this is an important moniker for us. People come from all around the world to visit here to learn about the ways of the semiconductor, the ways of software, and all of the things that semiconductors enable. Obviously, Intel Corporation is a big part of that. So we draw people here, but we also go out across the world to teach people how entrepreneurship works based upon Intel. And I want to give Intel a big thanks. We recently received an award from the Global Consortium of Entrepreneurship Centers for our work that we have conducted in cooperation and sponsorship by Intel Corporation. Intel Corporation has been sponsoring us at the Leicester Center to go around and teach other academic institutions how to build entrepreneurship centers. And we're delighted to have received an award from the Global Consortium of Entrepreneurship Centers, recognizing the work that Intel and the Leicester Center has done around the world. We also have a much stronger relationship with Intel Corporation, and that relationship stems from a lot of work that is done here at Berkeley in the research labs. Intel is a tremendous sponsor. But also the next Entrepreneurs Forum coming up in November is the Intel Berkeley Technology Entrepreneurship Challenge, where we have many teams. I think we're going to have a record number, 28 teams coming from around the globe here to compete on their technology business plans. So we hope that you can join us for that. So with that, let me introduce Laura Oliphant. Laura is with Intel Capital.
Hi.
And she's going to be our host for this evening. Laura,
thanks.
Pleasure to host you.
Okay. So just as a few words of introduction to myself, I'm actually a graduate of the College of Chemistry. I got my PhD in chemical engineering in 1991, working for Charles Tobias, who's now deceased. Since there was a lot of engineers in the audience, once I graduated, I went to Intel, and I was a process engineer for 4 years in our factories. In 1995, I decided to go over to the business side, and I spent 7 years in the capital equipment development group, working with suppliers on development of new technologies and new equipment for such. And just after September 11th, I went over to the Intel Capital Group, and I've been making investments in semiconductor technology ever since. So this is a viable career path for you. So we're here to talk about Moore's Law 40 years later, and I'm going to give a couple slides to ground everyone on the topic. Since we have a lot of engineers in the audience, you guys should mostly be familiar with it. And then I'm going to briefly introduce my panelists, and they're going to come up and say some words about Moore's Law and introduce themselves further. Basically, Moore's Law was first postulated in a paper in the 1960s. It was basically an observation by Dr. Moore that technology density doubles every 2 years, and that we want to keep on that kind of a cadence. Over the last 40 years, it's served as what I would characterize as a pro forma roadmap for the industry. You can see here an Intel's roadmap. Intel has been keeping to that cadence since as long as I've been at Intel, since 1991. We introduced our 65 nanometer technology in 2005, and we're following that up with 32 nanometer in 2009. And as far as continuing Moore's Law, we have many technologies in the pipeline that will be used in future technologies, and you can see all those in the 9 slides here, in the 9 pictures here. Just to give you an example of how innovation has changed since 1978, here's a photograph of a contact from that time period. And just this last year, you can now fit 10 32 nanometer SRAM cells in that area. And just to show you how the innovation has gone, in 1968, Intel was founded. You know, the 8088 microprocessor, Gene can tell you how many transistors that had on it, much more than I can, but it wasn't very many. And now we're in the many billions of transistors and with many more features on your microprocessor. So without further ado, I'm going to turn this over to my panel, and my panelists are Gene Myron, who's a retired senior fellow from Intel. I have Bruce Rhine over here as the chairman of the board of Nanometrics and a serial entrepreneur in this industry. And I have Alexei Andreev, who's the executive vice president of Harris & Harris. And so we're going to start by having Dr. Myron come up and say a few words about Moore's Law. Thanks.
Well, I'm Gene Myron. I joined Fairchild Semiconductor on June 23rd, 1963. I left Fairchild Semiconductor in June 23rd, 1973. I joined Intel Corporation on June 23rd, 1973. And I retired from Intel just about June 23rd, 2009. So it's a little over 46 years in the industry. I was hired by Gordon in 1963, which predated, of course, Moore's Law. I did a lot of work in analytical materials and materials analysis, materials characterization. I worked a lot with the people here in Berkeley, particularly in electrical engineering, computer science, as well as in the material science department. So I used to spend a lot of time up here, especially at the time of the tear gassing on Telegraph Avenue and all that stuff, which not too many people now remember. At Intel, after I did my materials thing, I got interested in artificial intelligence and knowledge management and process control and all kinds of things. I was made an Intel Fellow in 1984, and I remained a fellow up until I retired. I became a senior fellow in 2004 or something like that. So I've seen a lot of the industry. I don't know anything about the devices, but I know a lot about the processes and the technology. But basically, as everybody really knows, it's not a law. It's not like the law of gravitation, even though the law of gravitation as proposed by Newton changed and became the laws of gravitation as proposed by Einstein. But it's more a self-fulfilling prophecy that once people saw that people really were building devices that doubled in complexity periodically around 18 months to 2 years, everybody got on the bandwagon and became an economic driving force to be competitive. You had to stay on Moore's Law in order to stay in business. So Moore's Law became synonymous with the driving force for technology and what was going on, the self-fulfilling prophecy. But it became obvious that it's generally applicable to technology in general. So I think that for the entrepreneurship ideas within this forum, it is good to recognize that Moore's Law applies to more than how many chips you can make and how many devices you can put on a chip. It applies to a lot of the development of technology in general. But competition arose to stay on Moore's Law, and for the last 4 decades we have managed to do that. And given the state of silicon technology, it looks like it's good for another 10, 12 years until some other innovations, maybe in silicon technology, maybe outside silicon technology, will keep it going. So here's Moore's Law. You can see it going from the early 70s with the invention of the microprocessor. Actually, Gordon proposed this in 1965 when we were making 16-bit devices. About every 2 years, 18 months to 2 years, until you come up to the fact that you're putting 1 billion transistors plus or minus onto a silicon chip now. And as a consequence of that, the cost dramatically dropped, and so this is sort of Moore's second law, which is that the cost also goes down exponentially with the same periodicity as does the increase in chip density. And of course, the people that are in business want to know, can you continue on this cost curve? Since I know nothing about economics or business, I won't answer that question. I'll just tell you about the technology. But you should note that other technologies have followed Moore's Law with a different exponent or a different periodicity. For example, the number of internet users rose faster than Moore's Law predicted for the number of transistors on a chip. Similarly, the number of cell phones that are sold is rising faster than the speed of which transistors grow on a chip. So if you want to know where there's business, there's a lot of business around. You just have to be smart enough to choose the right one. Other industries have done the thing. If I were to look at another industry, for example, the aircraft industry, it has a periodicity of about 10 years of doubling something, and the thing that it doubles is roughly the number of how long it would take for a single passenger to travel a certain distance, the time per passenger mile. So you started out with the Wright brothers, and it would take, X number of days to go across the United States if you were flying at that speed for one person, and now you fly an 880 with 800 people, and it goes, 500, 600 miles an hour, and you have that number of people going in such and such a time, and you have roughly a Moore's law for aviation and for aeronautics. And indeed, if you look, you could find that many industries do that, whether it be the analytical industry, the resolution limits of equipment. If you wanted to plot that, you would find that goes down equivalent to Moore's law. A lot of places do that. So it's very important to understand that. This is Gordon actually receiving, he became an honorary Intel fellow a number of years ago, and this is when he was presented with that honorary fellowship. So basically, I want to finish by saying that Moore's law is only in a straight line when you view it from far enough away. If you look at it in detail, you'll find that there are jigs and jags in that line, and it's almost like a fractal in appearance, because the jigs and jags happen because of innovations in a whole bunch of different fields that happen asynchronously. At sometimes it's materials that's a limiter, and the materials people have innovations to make bigger wafers. And then another time it's a process control methodology, and another time it's the lithography tools, and another time it's the design tools, and then it's back to the materials, and then it goes to the analytical tools. So really, Moore's law is not a straight line. It is filled with lots of jigs and jags, and if you take each one of those jigs and jags and magnify it, you find out there are littler jigs and jags within there, that there's a lot of room for improvement and for Moore's law for, as far as I can see, into the future. Now, it may not be silicon, it may be biomaterials, it may be plastics, it may be composite, it may be atom layer materials. I don't know what it's going to be, but sure as shooting, there is going to be that improvement. I want to finish my comments by saying that, contrary to popular belief, Gordon was not always right. He gave a talk for me back in the 1980s, which I thought was very good, and he put out something which was the way that he would have projected Moore's law if he were to use the term Moore's law, which he was always against, and it was on wafer size. But it didn't have the right kind of persona there, so we created this other slide, which he used in a presentation for me back in the 1990s. And that was his prediction of wafer sizes for 2001, that if he had projected his plans, he would have had a 57-inch wafer by now. Right now, we're at 450 millimeters is coming up. So Gordon wasn't always right. He's very proud of this slide, though.
Hi, I'm Bruce Rhine. I am the chairman of Nanometrics Corporation. Okay, so before I get to this foil, I want to talk a little bit about my background and then talk about how this foil may fit into the subject here tonight. So I held my hand up. I have an engineering degree from chemical engineering degree from Penn State, MBA from Penn State. I've spent essentially all of my career bouncing between entrepreneurial activities and running parts of businesses for the semiconductor supply chain. Reading the pedigree of some of my fellow panelists and my host here tonight, I quickly realized that I'm kind of the dim bulb in the chandelier here. So I'll do my best to hold up the end of it, but I'm probably can maybe season that with a little bit of entrepreneurial activity, and some of it smacks close to Berkeley, actually, when I was thinking about this. So I've been involved as a principal in 9 different deals. All of those deals took advantage of the jigs and jogs that Gene talked about. We were always seeking some kind of a disruptive way to insert our technology into the food chain. And those deals represented a total capital raise of about $110 million. And one of the things that I'm most proud about is that all those deals had a positive return. Now, I've invested my own money as an angel investor in plenty of deals that haven't had a positive return, but when I've taken other people's money, we've had a positive return. In fact, one of those deals was, if I remember correctly, the winner of the 1999 Berkeley business plan competition, a little company called Timber Technology, and I was fortunate enough to get involved with those folks and help them put their first round of financing together. And 15 months later, I couldn't have done this, but the CEO that I recruited sold that company for $125 million. So they went from business plan competition to $125 million in cash, which was back in 2000, 2001 was kind of a good thing to have relative to stock. So, so anyway, a couple things I wanted to talk about regarding the supply chain. A lot of things that are good for supporting Moore's Law aren't necessarily good for the supply chain. A couple of those that come to mind are and have led to consolidation is wafer size change. You know, wafer size change is capital productivity, capital efficiency for the semiconductor manufacturer, but someone loses when there's more productive capital, and that's the size of the market. And the other element is one of the nature of our business is that we've always sort of been very practiced non-business practices and been very aggressive about supplying the industry. And in that case, typically we get involved with runoffs where a lot of R&D money and development money is staked on the return of if we were to win the business, if that supplier were to win the business. And I'd submit that there's no other industry in the world that would take that amount of unfunded R&D liability and attack the business. And of course, part of it's on our own, where the fundamental market for our product, demand in that market is inelastic, and the inelastic demand is often misconstrued as cyclicality in the business. But if the customer doesn't need an increment of additional capacity, they're not going to buy the tool regardless of the price. So it's a perfectly inelastic market, and that's often misconstrued for cycles. And so what this foil references is, and when I went back, one of my first jobs in the industry, I sold a business to Lam Research, and when I came to work at Lam as vice president of marketing back in 1986, we identified 43 separate distinct suppliers of etch equipment to the semiconductor manufacturing business. And right now there's about 3. So that's the level of consolidation in that sector. But here you can see across the whole food chain, these are different unit operations that are involved in manufacturing, and then of course measurement and automation. And you can kind of get a feel for the level of consolidation that's occurred over really a relatively short period of time. This is a supplier base, probably a historic supplier base, and then this is how it kind of consolidates. And a lot of this consolidation is not necessarily, it's survival-based consolidation, or it's acquisition of intellectual property, a few mergers of equals and things like that. Okay, and then this is what we're left with today. These are the independent suppliers to the industry, and this is probably a drag on Moore's Law, because the extent to which the customer who's trying to drive device density relies on the food chain for innovation. There's fewer and fewer people that are willing to play the kind of reverse eBay auction, where the person who puts up the R&D and engages in the runoff is the person that gets the return through the business. And that's a structural problem that probably drags on the industry. So if we take a look at that, the 6 leading companies represented 35% of the business 10 years ago. Now they represent 46% of the business. So it's just I don't think it's good or bad. I think it's just a factor. And I think what will happen over time is that these companies will adopt more traditional business practices, which will be risk sharing, cost sharing of R&D, and that will then place more of a burden on the semiconductor integrated circuit manufacturer, and maybe act as a little bit of a draw to address those jigs and jogs that Gene was talking about. Okay, so I look forward to the discussion today, and thank you.
My name is Alexei, Andreev, and I'm a managing director and EVP of Harris & Harris Group, a publicly traded venture capital firm which for the last 8 years or 9 years invests exclusively in nanotechnology and advanced materials. And so a few words about myself. I started my career as a theoretical solid-state physicist. I worked in academia, got my PhD, worked on quantum dot heterostructures and, say, LED and filtering applications, and then turned to the dark side and joined an investment bank as a quant first, and then transitioned to the private equity deal-making side in Eastern Europe, and then worked in London. Then at some point I decided to go to business school, and I picked up the one across the bay, which is not number one, but the most selective business school in the country in terms of number of people they accept, and joined Draper Fisher Jurvetson venture capital fund, started doing nanotechnology advanced material deals in 2002, and in 2005 transitioned to Harris & Harris Group, opened Palo Alto office in Silicon Valley, and so I've been investing in nanotechnology-enabled companies ever since. So there are two unusual things about Harris & Harris. The first one is we are publicly traded, and so we are organized as business development companies, so I absolutely have to show this slide to you. And the second, we invest in advanced materials and nanotechnologies, and that's the only business we are in. We've been around for the last 25 years, and we have 5 people, 2 on West Coast, 3 on East Coast. Out of 5, 3 are former scientists, and we have 2 tech transfer officers, and so we tend to be pretty technically deep. So as of today, we have roughly 30 portfolio companies distributed between clean tech and healthcare, as well as electronic and semiconductor components. I will touch base on a few of them down the line, and we believe a few of them are working hard to extend the Moore's law. And it goes back from, say, conventional extension through analytical tools to novel ways of lithography, to completely new structures and new materials used to push, say, logic forward or computational models forward, but I will touch base on those companies down the line. And so what else can I say? We have 4 companies in our current portfolio originated from Berkeley and LBL. We have good footprint on the East Coast as well. We syndicate with a bunch of traditional venture capitalists. And thank you, Laura, for having me here. We have quite a few deals with Intel Capital, and we seemingly have very similar investment interests as long as it goes to extending Moore's law. And so this is a snapshot of our current portfolio. So if you have any questions during the panel conversation, I'll be happy to address them. But essentially, we started doing deals a few years ago, and now the portfolio is maturing, and we have a few companies such as Molecular Imprints, which is working on next generation nano-imprint lithography as an alternative to deep UV, revenue stage, growing revenues. We are investors in X-Ray, and by the way, both of those deals we did with Intel Capital, which is working on X-ray imaging system. It's a spin-off from LBL. We have companies such as Covio, which is working on a completely paradigm shift. As a spin-off from MIT, they're working on printable electronics, and they have silicon inks, N-type inks, P-type inks, memory inks, and they're building a fab in San Jose to start producing ultra-low-cost electronic devices using print to save on capital expenses and essentially transcend the Moore's law, bringing very low-cost yet fully integrated device through the runs, printing runs. So what else? We have 2 memory companies. One of them is Nantero, which is using carbon nanotubes to build memory cells, and they're pretty stealthy, but they are announced a major transaction. They sold their government-related radiation hard business to Lockheed Martin, and they keep working on memory cells, and so the technology, we're cautiously optimistic about their ability to bring something new into conventional silicon space. We have another play called Ardesto. They're also working on alternative memory structures, and one of the deals we have called D-Wave in our portfolio, those guys are building a diabatic quantum computer based on superconducting circuitry. And so we have a play where people are trying to completely change computation model, and we're cautiously optimistic about the progress to date. And it seems like they will be able to address NP-complete and NP-hard problems in polynomial time. It's not a universal machine, but at least for certain classes of problems, we see some positive indication that they will be able to deliver answers to the problem we have not been able to deliver before. And so just transitioning out of our portfolio and a few thoughts about what we see in the venture capital community. Most of those deals, one of the common factors, they're very capital intense, and time to market or time to the product is pretty long. We're talking about 6, 7, 8 years, sometimes 10. And venture capital is more like playing bridge versus playing chess or playing poker. You don't know all the cards up front. You have to pay to flip the next card. And so a venture capital community is getting really, really concerned that you have to pay a lot up front to see the results on the back end. And so one of the most recent observations for the last few years, venture capital community is investing heavily in deals which are relying on existing infrastructure. For example, consumer internet. You already have optical cables put by somebody and operated by somebody. You have Cisco routers, you have Google search. And what you can do, you can throw a little application which will benefit from existing ecosystem or infrastructure. With all those type of deals, and especially deals pushing the Moore's law, or many of them, you have to build your own manufacturing infrastructure. You have to build your own fab. You have to bring something fundamentally new, and it takes a lot of time, it takes a lot of money, and conventional venture capital LP structure is not well suited to do those kind of deals. And so as a result, you have a limited number of investors interested in this space, and there are many strategics who are still doing deals. There are a few guys like Harris and Harris Group with permanent capital, and so we're not limited by 10-year life of the fund, and we can take long-term bets if we believe in the big future. But whenever you do those deals, you should keep in mind it will take time, you should be patient, it will take capital, and most importantly, it will be hard to find a new lead investor for the next round. And so on one hand, there are plenty of companies today, many of them revenue stage, few of them even profitable, where you can come and invest at pretty much any price because there is no competition. And price per share and the valuation of any company is mostly determined by the competition. And today there is no competition for those deals. And so it's on the good side, you can do a lot of deals and have favorable terms. On the negative side, as Bruce just mentioned, you don't have a lot of acquirers. And so 10, 15 years ago, a company could grow to a certain size and then file S1, and then for everybody it was a signal, hey, we'll go public and we'll be a standalone public company. Today, it's not going to happen. You have to hit $100 million in revenues to be considered to go public. And with all the consolidation in the semiconductor equipment space, instead of 87 potential acquirers, you get to 30, and in reality, you get to 6. And they all know about it. And so there is no pressure on the side of acquirer to pay up for what you built. And now you have this phenomenal decoupling between value creation and value acquisition. So all those companies, startup companies, are creating phenomenal value, but they cannot capture enough to justify a risk return in most cases. Not in all the cases, but in most cases. And so my biggest question, we keep doing those deals. I think we are quite fortunate to be well positioned to pick up a few, hopefully successful companies out of a sea of companies struggling to find funding. But at the same time, I would like to share my concern that Moore's law extension is not in the favor, at least as it goes to the hardcore technology. A lot of investors are trying to find better ways to deploy their money. And so most of the innovations, or a lot of innovations, coming from large companies and not from small companies as it used to be before. Thank you.
So I'd like to invite my panelists to come up to the podium and take a seat, and we'll take some questions from the audience.
I'll make a couple of general statements. You know, the whole idea of, quote, a paradigm shift is probably most often a misnomer, that paradigm shifts do not occur as a step function. They occur over a long period of time. If you go back in history and look at the transition from the vacuum tube to the transistor, None of the people that made the vacuum tubes went into the transistor business because they thought that if they competed in terms of making better vacuum tubes, better glass seals, cheaper tubes, higher performance, that they would do away with this upstart thing called a transistor. But when the transistor came on by Shockley in 47 as the invention of the company in 1958, the Fairchild 8 left a Shockley transistor because they didn't think that the management style was particularly conducive. So you're talking about 15 years before even people started to think of transistors. And then Gordon Moore once told me, he said, when they were trying to go out and sell the idea of transistors, a lot of the people just didn't want to buy them. The quantum computing, the quantum dots are going to happen, but it's probably going to take an enormous amount of time, A, because the scale of the devices, B, because the programming methodologies, and C, because the pure logic of these bizarre state kinds of things is going to take time to come. So I would say that in some ways they are the device equivalent of gallium arsenide. They are the future, but the future may not occur for a while.
Yeah, I'll be happy to comment, and it can be extremely technical, and so let's talk offline if you really want to know more. But essentially, we are a little bit more optimistic on the quantum computer. We believe we will have some first results will be seen by the industry in the next couple of years. But the largest problem with a quantum computer is scalability, exactly as Gene told. And theoretically, you can build a quantum computer. So you have two problems: how to build it and what you can use it for. And there are two separate problems. And so the first question is how you can build it. I think we have a decent grip on one of the ways to build it. And historically, the largest problem was scalability and how you can build something you can interact with using conventional I/Os, and how you can manufacture at a high yield, and how you can repeat, kind of how you can build thousands of processors versus just one thing at Lawrence Livermore Lab using unique equipment and postdoctoral students, and then you operate it with people in white uniforms. And so the question, how can you build it in a meaningful production fashion? And so our portfolio company, D-Wave Systems, they're using SQUIDs, and it's called a diabatic quantum computer, and the model of the computation was invented by Seth Lloyd and Ed Farhi at MIT. And now this company is using conventional semiconductor fabs here in the Valley to produce circuitry out of niobium. And yes, it's exotic metal, but you can run it through conventional applied materials machinery, and it will give you a resolution, and it will give you the right yields and performance characteristics. And so, in a sense, we are, again, cautiously optimistic. We're getting there, and the architecture seems to be scalable, and we're not out of woodworks, but at least we're making progress. The second question is what you can use it for, and it's a much more fundamental question. So today there are 3 or 4 known algorithms which are getting, I would say, exponential speed up if you have a quantum computer. And one of them is finding prime numbers, and I absolutely don't want to talk about it. It's Shor's algorithm. And then you have an algorithm to do fast Fourier transformation. And you have an algorithm to search dispersed databases. So if you have databases with a lot of zeros and a little bit of ones somewhere, you can search it in exponential time comparing to conventional heuristics. And so there are a few others. And so as of today, even if you have a machine, there are only few algorithms in few areas where you will get a real speed up and bang for the buck. One of the areas is, for example, image recognition and image search, because what this D-Wave machine does natively is essentially superimposing graph, and it's minimal independent set problem if you have enough mathematicians. So it solves minimal independent set exponentially faster than any conventionally known algorithm. And so you can find certain applications, and some of them are high-value applications. But I really doubt we will see quantum computers taking over the world in the next 10, 15 years, 20 years, replacing digital machines. I think there will be coprocessors for certain classes of problems like quantum mechanical simulation and image recognition and image search and pattern matching type of applications, but everything else will be computed on Intel-powered machines. That's the reality. And so for quite a while, we will have, at least that's my vision, if our company is successful, we'll have this quantum coprocessor next to Intel cluster, and who knows what will happen in 20 years. I don't have a crystal ball. Again, it can be extremely technical, so if you have any particular questions, please, later on.
Do they use less energy? I'm just curious.
They use significantly less energy, and so frankly, the only energy they use is to cool this thing down. It operates at 0.0001 Kelvin. So it's interstellar space. It's way cooler than the solar system. And so it's a fridge. You plug it in the wall, and it consumes, I don't know, 500 watts to maintain this temperature, and that's it. The heat dissipation is negligible. We're talking about nano, if not picowatts, not per computation cycle, but per hours of functioning. And so energy is not the issue. It's extremely energy efficient. The problem, again, the biggest question, how you transition from a few value-add but very specific applications to a broader application base, and how you introduce the programming language and how you translate existing programs to work with this coprocessor. So it's not a cookie cutter, but at least I personally think, and I'm cautiously optimistic, we're getting somewhere. But big question marks.
Bruce, any comments?
Yeah, the thought regarding the quantum dots and even sort of biological computation, that is sort of there's one vector there, which is computational speed or computational switch density, switch speed, switch power consumption, those dimensions. But the other dimension is sort of an economic dimension, which is a risk-adjusted return. And there's two components to that. And, if you look at the return component of it, you can't really get a return on investment on a transistor, even if you put 3 billion of them on the head of a pin and call it titanium or something like that. It doesn't even have nutritional value. So you have to incorporate that into a system that yields functionality, that yields value that someone will be willing to pay for. So, and I think that's kind of the heart of what drives Moore's Law. And then on the risk dimension, to properly enter this market, whether you have your own factory or you're subcontracting out to in a fabless business model, you still need to invest about $3 to $5 billion in that factory, and so it's really risk management at the manufacturing level and the architecture level, and it's very difficult to accomplish that. So the question is, how do you achieve more functionality so you can grow more value? And I think what you find in the industry is using the z-axis to obtain functionality. Tremendous advancements in packaging, stacking chips, thinning chips down, the protocol and innovation in switching parts of the chip off to reduce power consumption, those sorts of things. It's a lot cheaper and a lot less risky than changing the fundamental architecture of the transistor.
The genuine answer is no, although people have talked about it, but it's just pure speculation. There are a lot of people that were interested in fractals and all that chaos theory and all the stuff that went along with it for a number of things, particularly in imaging kinds, but not really, as far as I know, in the chip design. Let me point out one thing that would relate in general, because I do a lot of teaching on innovation, and I try to, sort of give Intel impetus to be more innovative and receptive to innovative ideas. And what you have is, like any large company, an enormous inertia. So ideas such as what you are talking about are very, very difficult to, even in a company that is regarded as innovative, it's very difficult to get through the system. So as I say, there are people that think about these things, and we have a lablet, like the lablet here in Berkeley, and we have one at Carnegie Mellon, one at the University of Washington, and there are individual people that look at these things, but trying to get that idea into the mainstream of coming up with the next 5 billion transistor chip, it doesn't succeed very well. So a couple of things that happen that really get attention that are of that nature, you know, the sort of what you would call the paradigm shift, you know, was, for example, this idea of strained silicon, which caused things to, you know, operate faster and, you know, get better performance. But that was a very, very secret affair, and it was funded at the highest level by somebody that understood the real implications in terms of the stuff like, you know, what you're talking about. It would be a struggle, and I think it's a struggle at every company to take these kinds of innovative, creative ideas and get them into the mainstream.
Next question, over there.
Biotechnology instrumentation has been following a Moore's Law path, and that's driven new biology information doubling every 8 months or so. But biology application hasn't been able to follow that. We're actually getting a smaller number of drugs per year. Are there any other examples that have followed a similar pattern that we might learn from to try to figure out how to better apply Moore's Law and get its value in the biology area?
I think there might be some interesting
Let me not answer
comments
from
on
the biology area, but let me answer from a different thing, is that it was always said that, you know, what Intel giveth in terms of speed, Microsoft taketh away in terms of doing things. The whole business of software is very much in the same kind of a thing. There are a lot of advances in software that, you know, could parallel what you say is going on in the biology, but software productivity has not advanced at anywhere near the rate of the applicability of Moore's Law in terms of technology. So I think that the biological applications and the software technology are probably on very parallel paths.
Yeah. You made an interesting comment about, you know, how, you know, biological innovations are going out, but yet you don't see quite as many drugs. And I think there's an interesting thing which I want Bruce to comment on is, you know, what about the role of structure and government in innovation? And maybe you can make a few comments on that.
Yeah, I have a, well, you've just hit a hot button. And,
I know I did.
Yeah. Yeah, so, you know, one of the, and you know, we're all products of our own experience, and I'm significantly jaded by these experiences, and in that I came to work for Nanometrics. I created a company, spun a company out of another company, tried to get it public twice, and was actually had filed an S1 and were effective in the summer of 2004, but never had an opportunity to market the product. And I was right in the middle as an entrepreneur of the post-Enron fallout, where Sarbanes-Oxley legislation was considered and imposed upon public companies, and the effect of that, the unintended consequence of that, was it dramatically raised the cost of capital to entrepreneurs by essentially locking you out of the public market at that level of revenue that would be, say, maybe between $25 and $100 million. And the reason for that is it's an extraordinary regressive tax on innovation, on that capital, because to be compliant, whether you're General Electric or whether you're Nanometrics, it really doesn't cost that much. So as a percent of revenue, you know, it goes from 5% to maybe 0.03% of revenue to be compliant. And as a result of that, if you're a venture capitalist or you're you know, you need one more round to get big enough to have that scale, and it's that much more risk, and therefore it necessitates an exit strategy, which is an acquisitive exit strategy. And the issue with that is that it's hard to control. Sometimes those have very successful outcomes, but you're not in control of it, because to get that ultimate value that's going to drive the risk capital into that market, you want to be in control of that, and largely you're in control of that by timing the IPO. So, so having lived through all that, and then furthermore, just an anecdote, I would submit that the vast majority of the money that it takes to be Sarbanes-Oxley compliant adds no value to you to the public investor, because if a company, if an individual or company is going to commit fraud, they're going to commit fraud, except they're going to be sneakier about it. And if they don't commit fraud, well, they're not going to commit fraud anyway. So, there's already laws against that. But anyway, I think that has a dramatic, and I think it does factor innovation. I think it factors efficient deployment of capital, and it affects everybody in the United States, really, because there's other public markets that reduce cost of capital.
I'd like to a little bit counter this opinion. We are publicly traded, so we are SarbanesOxley compliant, we're mutual fund compliant, and with BDC, we're a regulated company under 1940 Act. And so we have massive amount of compliance. So does it add cost? Yes, it adds cost. And you would say to be SarbanesOxley and all the bells and whistles compliance, and you have a excitation barrier you have to come through, and then it kind of getting streamlined, pain in the ass, but it costs you, say, $1.5 million a year. And so that's the price of Sarbanes-Oxley. I don't think, and we don't see strong evidence that this is the reason why companies don't go public. I think what really happened, and it's also post-Enron phenomena, is think about investment banking and how those guys earn money. So the traditional model was I will have corporate finance people which are trying to bring company public, and I'm bringing company public. I have my research covering this company, and then I have traders who are executing on trades, my client's brokerage trading this particular firm which I brought public, and I'm covering on the research side. And so in the pre-Enron time, investment bankers would cut here and there and there, and then if you look at, say, large investment banking firm, they would have 3 streams of revenues coming from just one transaction, in particular bringing a company public. So what's happened recently, 5 years ago, there is an iron wall and people go to jail if researchers are talking to corporate finance people. And so corporate finance, they earn their money bringing companies public. And researchers are now cost center. They used to generate something, now they're a cost center. And so they're paid by a brokerage trading floor. And the brokerage trading floor, in order to generate money for themselves, as well as for research guys, they have to trade something big. If it's a General Electric, they will have enough trades every day, making penny here and there, to generate enough P&L to kick back to cover research analysts. Okay. And so today's reality is you're trying to go public. You're a small company in terms of market cap. Large mutual funds will not invest if you don't have research coverage. And you will not get research coverage if it's a small market cap company, because no one is paying for research coverage if you're sub $250 million company. And so we don't see it as a problem with Sarbanes-Oxley. There are a lot of companies who can digest $1 extra million and 1 extra layer of reports. The problem, even if you do it, the current investment banking regulations and setting is such that no one benefits from taking public small cap companies. It's just impossible to do, given the regulations and given the incentive structure.
So let me go on to another question. So you in the center, and then I'm going to come down to you. So you're up.
Yeah, thanks for the great insight today. My name is Won Choi. I study Haas business program in undergrad. Yes, when I think about Moore's Law, the first company that comes into my mind is Intel. And I think Intel is doing such a tremendous job in the PC side. But for the wireless and mobile side, it still seems like Intel is now having not as fun time as before. So I was wondering, like, what's the Intel's strategy now as more focus as for the mobile industry is becoming like focused on to energy consumption compared to higher computation.
Go ahead.
Being retired from Intel, I'm hesitant to talk about what the strategy of Intel is. But I could say that there's been, obviously, a certain amount of the, quote, the excitement and fun has disappeared since, you know, the crash of 2001 or 2002 or what have you. And people started to look at it not in terms of the revenue that the company generated, which has always been substantial, nor of the profitability of the company, which has always been substantial. You know, we've been at a 50% profit margin, and we say, well, how come companies at 3% profit margin are getting all the excitement with 1% of their market share, and we have 70, 80, 85% of the market share, and we have a 50% profit margin? It's because I think that the people such as are sitting to my right look more at the growth phenomena, and they see that, yeah, you know, we're going to sell more devices, we'll sell more PCs, and we'll sell more chips, and we'll sell more in controllers, and we'll have more in cell phones. But they don't look at it like they looked at the explosion of what happened in the early days of Intel. So Intel is looking for these areas, and that's exactly what this young lady is looking for all the time, is for these opportunities, both that generate the excitement in the market, that generate the technological breakthroughs that are needed, generate these huge increases in things, you know, like the iPod, obviously, the iPhone and the iPod certainly did these kinds of things. But we are not a company that makes iPods and iPhones. We are a company that basically makes components. So did the fun go out of it? No, it's still very exciting. Is it as profitably exciting? No.
I think I want to make a comment about you know, wireless and things like that. I mean, you know, through our Intel Capital activities, we're still very active in building the ecosystem around wireless technologies. I'm not an expert in this area, so, you know, but I know we're still very actively investing. So let me go ahead and do.
Now, Moore's law has to come to an end at some point.
Why?
in the way it's done for the last 60 years, which is you have electrons carrying information, and eventually you'll get quantum tunneling, and at some point that will become impractical to go further, and you also get high variability because you're getting down near atomic limit, and you don't have atomic precision. So what will occur is a big organizational shift at the small level to atomic precision, to molecular memory, to essentially probably putting molecular precise structures as a 2D pattern on a larger 3D chip. And so this won't change the computational paradigm, because you're still going to have the same von Neumann instruments, you still use exactly the same languages. But it's an enormous change in terms of the process architecture. And I was wondering how you see this major shift changing. Now, of course, what happens is actually there'll suddenly be a whole lot more components, so it'll go much faster as you go to the molecular scale. But it will occur with enormous, big, sudden increase in cost and invention to get there. So how do you see that institution playing out?
I can start. I agree with you that it's going to go down to that level, and you didn't mention the fact that it will go also into the biological level in parallel, that these two things of going down in size to other particles, atom size, even below that, if it's at some time in the distant future, will be in parallel with combining with biological kinds of processes. At this time, the investment in that is, you know, it's going to take a long time to get to that. And therefore, what we do is we tend to spend the money for the research and development in those areas by funding universities, Berkeley, Stanford, and so forth, or the national labs, or or what have you, to do the fundamental research into how to manage the processes that are going to be necessary. Because, you know, it'd be such an enormous undertaking to do this that Intel as a company will not do that internally. So we will watch what's going on in the universities. We will fund selective areas to look at these things as they become viable, knowing that it's going to be a, you know, a 20-year or something like that process in order to get to the thing. Let me just mention one humorous thing, though, and that is I was a judge at the Intel-sponsored International Science and Engineering Fairs a number of years ago, and one of the kids there was doing, these are for high school kids, and there are 1,500 booths that you go through and you try and see what's going on with all these kids. And one kid had a thing where he was looking at molecular plastic transistors. And we thought this was kind of neat because he was now taking Moore's law down by another 2 or 3 orders of magnitude. And his name was Thomas Moore, so we felt we didn't even have to change the name of the law to accommodate him.
So, other comments, Alexei and Bruce?
Yeah, so I guess I have pondered Moore's law quite a bit, and I think that you know, sort of there's a literal interpretation, which is number of transistors, but there's also another interpretation, which is unit of functionality. So maybe a transistor is a proxy for a unit of functionality. And you know, there's lots of other jigs and jogs and bells and whistles and ways to continue to scale units of functionality per, you know, given size of silicon real estate. So I think that if you look at the instability and the unknown factor and the amount of capital required to manufacture that computational capability on an annual basis, you know, to see that shift into an unknown, you know, to have that kind of risk, you know, that's just real money. I mean, there's what the annual, the market for semiconductor equipment alone in a bad year is 25, 30 billion. In a good year, it's 70 billion. That's a lot of, you know, there's a lot of folks in, you know, in risk-managed companies that are not going to, there's a lot of impetus to continue what's there and then figure out another way to gain the functionality.
But on the other hand, I believe it will happen. Well, yeah, first of all, Gordon Moore is one of the most unassuming human beings you could ever meet. He's you know, he's a billionaire, but he's not a billionaire. He's kind of a person that would come and sit down with you in the cafeteria to eat, and just a genuine, very, very, very pleasant, nice human being. When Moore's Law started, you know, he refused to use the term Moore's Law until just recently, that he actually said the words Moore's Law himself and admitted that this thing is, you know, is beyond his control in terms of the thing. But it was like Silicon Valley. He didn't invent the term Silicon Valley. I think that was probably either Jim Gibbons or Carver Mead that invented those terms. And Moore's Law just came out of an observation. You know, I was at Fairchild at the time when he was doing this. I joined in '63, and he was doing work with a guy named Bob Seeds, who died. Bob Seeds is one of those names you will never hear. He died in about 1967, but he was instrumental in working with Gordon on these original curves of just looking, and Gordon made this observation, which he didn't think much of in the sense of this will change the world and make him famous and all that. It was just an observation that says, I'm willing to bet Fairchild's interest on the fact that we will continue to improve complexity. We don't know what we're going to do with this complexity. And he often said that. You know, people would ask him at conferences, well, you know, you're going to put 1 million transistors on a chip. What are you going to do with it all? And he says, I don't know. But somebody will figure it out. And they did. So he really instilled this belief in the self-fulfilling prophecy, though, because he's the one that instigated what was known at the time the NTRS, the National Technology Roadmap for Semiconductors. He convened, just by the power of his name, 700 or so scientists and engineers from all the major semiconductor companies, including things AT&T, Bell Labs, Texas Instruments, Motorola, Intel, you know, you just name them, they were all there. And he came out and said, look, as long as we're doing this, we may as well put a formality on it. And that's what came out as called the NTRS, which later became the ITRS, the International Technology Roadmap for Semiconductors. And it simply came out of, you know, from my point of view, and I was at the group that was when he started the thing, it came out of Gordon Moore's personality. I mean, it's just an amazing visionary. When Dov Froman invented the EEPROM, which is a precursor for the flash memory and all that sort of stuff, it was, or when Ted Huff invented the microprocessor, it was basically on going to Gordon and say, hey, Gordon, here's an idea, which is different from the way things are in almost everywhere, including Intel now. And Gordon said, yeah, that sounds like it's a winner. And he would support it, and once Gordon supported it, then you just went on with it. It was, you know, working with him and Bob Noyce in those days, I always compared it to working with Orville and Wilbur Wright at the invention of the airplane. It's just an amazing phenomenon.
Yeah. So, other comments? Let me take you.
Yeah, I have kind of a question in that vein. It's narrow and also wide-ranging. You suggested that he had the time to go and put more transistors on a chip when he didn't know what people were going to be doing with it. What we've heard some gentlemen say tonight is Intel has done a good job of squeezing the fat that allowed people to do things like that. There aren't many companies that provide equipment that have time so where they can put more into it just because it looks like it's interesting. So the squeeze happening like that, I'm wondering where young engineers, people interested in making the innovations in this field, where they should go to look for the experience to innovate next. Are those going to be US companies? Are those going to be foreign companies?
Bruce, maybe you may want to comment.
Most of the folks that I know that are creative or trying to get out of our industry, they view it as mature, not a lot of growth. I don't necessarily personally believe that, but yeah, there's a flight of you know, intellectual capacity into other perceived more exciting industries. I mean, I think that's the way it is. It's the nature of it. It's you know, it's probably like any other industry that it consolidates and gets mature. And you know, I mean, more to the point. I mean, if you look at, you know, manufacturing used to be a huge differentiator. I mean, the fact that you could make a solid-state transistor that disrupted a vacuum tube, for example, that in and of itself allowed you to drive value because it enabled a whole different category of eventually integration. But you know, now it's sort of incremental improvement, very, very fine incremental improvement. And manufacturing it's probably as complex as any manufacturing on the planet. When you look at the volume and you look at the number of materials on the periodic chart that are used, and you look at the scale, and it's recursive manufacturing. It's not linear manufacturing. Very, very complex to manage operational components like cycle time and product mix and things like that. So from that side, it's probably, you know, some of the most biggest manufacturing challenges that are faced in high volume manufacturing are faced by the industry. But on the other hand, though, manufacturing doesn't differentiate the product per se. You know, all the value is captured at the system level, and you know, and to some extent by a networking effect, right? That's how Microsoft and Intel captures a lot of value there because of the networking effect. And you know, to this gentleman's question, I mean, I'm sure that keeps a lot of people at Intel up at night because you know, when the platform moves to the iPhone and that adds the value or whatever, you know, whatever it is, and it's off of an Intel architecture and a Microsoft architecture, which I think is inevitable. I mean, I think it's just absolutely inevitable because nobody sustains a natural, I don't know, I want to say the word, it begins with an M and ends in an opoly. But you know, they're just not, you know, the world doesn't allow that value creation to go forever. And you know, kudos to the management team that executes and allows that to happen and understands it and allows it to happen. But I don't think it's in manufacturing. I don't think that's where. I think it's more risk management and incremental improvement with known vendors, and it's really hard. No, you can innovate, but the customer is going to want to have it on a platform supported 24/7 by a global channel distribution, and you can't raise money to do that. You can't raise money to put the global channel distribution in, and you don't get the return.
We have 30 portfolio companies, so quite a lot of them are innovating. But I would like to bring interesting observation. I heard it from Andy Rappaport, who's a very famous semiconductor investor, and he was presenting at TSMC Development Forum last year. What he told to TSMC, and I guess it shocked them a little bit, and for people who don't know, it's Taiwanese semiconductor manufacturing company, so the largest producer of chips. What he told is, it's time to look, the world used to be a fabbed world, people used to make stuff, and now it's a fabless world. And so he believes the world will get full of fabs again. And the reason is the following. If you try to manufacture a chip at TSMC, and most fabless companies in Silicon Valley and over the world, they do TSMC or a few other fabs, and TSMC actually eating everybody else's lunch. They're growing, they have scale like Intel and a few other producers. So you're using standard libraries. And so if you look at the percentage, you look at the chip surface area, like 10 square, whatever, millimeters. So if you look at the percentage of the chip which is truly innovative, this percentage of the circuitry keeps shrinking. It used to be you designed the entire chip, and now you're using a lot of standard libraries, and now you're using even more standard libraries, and now TSMC is the only fab with a list of approved standard libraries. And so that the relative surface area of innovation is like collapsing to zero. And so the question is, with all those startup companies, how are they going to differentiate themselves if they're using exactly the same manufacturing process, exactly the same libraries, and their innovation essentially goes to zero. So it's the same chip no matter what you do. And so his vision is we are approaching the point where in order to survive, you have to introduce new stuff in the manufacturing process. Mm-hmm. And so the question how you can do it, can you build a new fab, or mini fabs will be in the business again because that's the only way to survive. And so Japan and SVDC and the guys who are playing with all those super exotic materials and nanotubes and all this chalcogenide glasses, they will have their shot. It's still unclear, but it's an interesting notion. So with some companies, TSMC is becoming larger and larger, they're killing innovation. And in order to stay alive, you should do something else, something totally different. And the question how it can be done is an open question, but at least people are thinking about it.
Yeah, great.
One very interesting data point, and Venture Source, I think, just released this information for venture capital activity. I'm sure Laura saw those data or data sheets. In the last 2 quarters, and you can reconcile those things in the following way. In the last 2 quarters, corporate investments from large corporations are pretty much all-time high. They're skyrocketing. The venture capital community is kind of in disarray. And the corporate players are stepping in. And so the way I see it is you will see a lot of innovation from small companies and startup environment, but they will be acquired very, very early without realizing their full potential as standalone players. And it will be Intels of the world or Apples of the world or Microsoft of the world introducing the new product they didn't develop themselves but acquired early on and just pushed through the pipeline. Think about pharma companies. All the large pharma companies, they're not developing the products anymore. They're buying biotech firms, but at least those guys are paying. I'm afraid in technology you will not see those type of multiples for quite a while. So they're picking up things cheaply.
With that, Laura, I'm going to sneak up on you.
It's going to kick me off.
Because that question actually addresses some of the things that we like to address here at Berkeley, which is keeping this innovation system alive. Here we are in the Silicon Valley. We've been doing this for a long time. We've been seeing these cycles for a very long time. We want to keep them here, and we want to have your progress on the mark too, whether that's through Harrison Harris Fund or from Intel Corporate Venture Capital or any of the other mechanisms that we can put forward to help innovation come through. So with that, Bruce, you have a quick comment?
Yeah, I have, there's one other source of financing, and that's your credit card. And as a serial entrepreneur, I would you know, I would encourage you right now where you're at in your life, before you start to add a lot of structural cost in the form of kids and mortgage payments and all that. You know, if you have an opportunity to be an entrepreneur, you know, I think there's a, you know, maybe like your postdoc would be to actually go try and do it in addition to studying it. Because there's still that opportunity that's out there, and there are quite a few innovative companies that are funded off 1, 2, 4, 5, 6 credit cards. You know, it's great access to funding.
And not to be funny about it, but you know, the other sources of funding, of course, your friends and your family, and non-dilutive funding like the government grants. You know, those can be very, very helpful in keeping, you know, getting your business bootstrapped.
Yeah. And I'll put in a plug for the universities. We have wonderful facilities here at Lawrence Berkeley Lab and Berkeley that entrepreneurs can use. UCSF has a core facility over there to work on the biological side of Moore's Law. We want to see a lot of progress there. So please join me in thanking our panelists and Laura and Intel in their support of this progress. Please join us on November 19th for the Intel Berkeley Technology Entrepreneurship Challenge. It's going to be a great show. So we'll see you all then.
Thanks a lot.
Good night.